Greetings, friends. This is Jon Queen with the Queen team at Coldwell Banker Realty, Chartered Financial Analyst, Chartered Alternative Investment Analyst, and licensed Realtor in the state of Colorado. And today I'd like to talk about how to depreciate rental real estate. It's a question that is constantly asked to me by clients. How do I depreciate my rental residential property? But before we get into that, please remember, hit that like button, smash that subscribe button, and join our channel so that you can receive constant updates and information that we provide on everything related to residential real estate property and living in Colorado. Now, when you own residential rental property, this is property that you own outright and you're renting it out to tenants, there's a tax savings feature that comes with that property that you may or may not be taking advantage of, and it's called depreciation. Generally speaking, if you are renting out property that you own, and it's residential property, you can depreciate a certain percentage of that property every year against your rental income from that property. So you can actually pay less taxes to the IRS. How does this work? Well, let's get into it. When you own residential real estate property, generally speaking, you can depreciate it based on 27 and a half years useful life. Now, there are exceptions to this, and I would like to say as a caveat, everything that I say in this video does not substitute for professional tax advice. If you have any specific questions about any tax-related issues, including depreciation or how to expense other itemized expenses in your tax return from your residential real estate property, please talk to your tax professional and get expert advice. I'm a realtor, I'm a financial analyst, so I can give you my view, but the tax code constantly changes. It may have changed since the last time I made this video, and it also has nuances in it that you want to make sure that you're taking advantage of and not potentially falling afoul of if you decide to file your own tax returns for your property. So always seek professional tax and legal advice on anything related to tax or legal topics. Now, having said that, when you own residential rental property, this is property that you own that you're renting out to the public, generally speaking, from the date that you first put that property out for rent, that would be when it's all prepared and you are giving public notice that it's rentable, you can start depreciating that property based on a 27 and a half year straight line basis. What does this mean? This means that if you have purchased your property and have combined purchase price and capital improvements and certain allowable expenses in an amount that equals to, for instance, $330,000, well, then when you depreciate that, when you divide that by 27 and a half, that means you have $12,000 a year for each of those 27 and a half years, or whatever period that you own it for that portion of 27 and a half years. You can deduct $12,000 a year against your rental income you're receiving from that property, and therefore pay fewer taxes to the IRS. So let's unpack that a little bit. There's a little bit to unpack there. The first is, on what basis do I depreciate the property? What is my numerator? If the numerator is the amount that you can depreciate and the denominator is 27 and a half, and that gives you your annual depreciation, what is the numerator? Well, generally speaking, the easiest way to look at it is that is the purchase price you paid for the property. It also includes certain allowable expenses, such as recording fees that were paid at closing, legal fees that were paid as part of your transaction, any debts of the seller that you assume, transfer taxes, and also, importantly, title insurance costs. Again, you would want to speak with a tax professional to clarify all of those things. Now, let's say the numerator is $330,000 when you include your purchase price and all the allowable additional costs that can create your basis, that numerator. Your denominator is 27 and a half years in most cases. There are certain exceptions. Talk to your tax professional. There are situations where you may elect, instead of 27 and a half years, to extend it out to 30 years. Or if you've been renting the property prior to 2018, potentially you also could be depreciating your property on a 40-year basis. So that will reduce the amount of annual depreciation you can use to offset your rents, but it extends the period of time that you can keep making this depreciation deduction from your taxable income. You would want to talk with a tax professional and understand the implications and the appropriateness of any method. But generally speaking, most people are depreciating residential real estate on 27.5 years basis, and that would be the denominator. What happens if you own the property and over time you make substantial capital improvements to the property, such as replacing the roof? That can be a $20,000 or $30,000 expense, for example. Certain types of expenses, like major renovations and roof or capital structural repairs, those typically can be added to your numerator to extend the amount of your depreciation. So your denominator stays the same. So you only have 27.5 years, generally speaking, unless you've chosen another method, to depreciate the property. But your numerator can be topped up from time to time and increase so that your annual depreciation amount may change. It may actually increase if you have major capital expenditures that you're using to extend the property's life. A tax professional can advise on that, but it's not the case that once you start depreciating the property, if there are significant capital expenditures you need to make, that you cannot use those in your depreciation. You can. You just add them in later for the remainder of the useful life. Again, a tax professional can advise you. Another typical question that comes up is, where do I take these depreciation deductions? Typically speaking, unless you own your property in an LLC or some other format, you will be taking your depreciation deductions in something called Schedule E to your 1040 IRS tax filing. And you would want to, again, compare all the amounts that you put into that Schedule E with a tax professional to make sure that you're taking full advantage of all the deductions and depreciations you can take, in addition to not accidentally submitting incorrect or overstated information to the IRS, which would be a problem down the line if you get audited, of course. Another question that people ask is, what about commercial property? I own a strip mall or I own an office building. Is that also 27.5 years? Typically speaking, no. That type of property is 39 years usually. So the same type of rules apply in the numerator, where it's your purchase price plus some allowable capital expenses, plus your certain closing costs such as your title and recording fees, legal fees, unpaid costs of the seller that you agreed to take on. But your denominator is 39 years as opposed to 27.5. So that's one nuance right there. Another question that comes up is, hey John, I owned my property as my own personal residence for the first few years of my ownership, and I decided to start renting it out this year. When do I start my depreciation? Well, depreciation, the 27.5 years in the case of residential real estate, that begins the month that your property is available for sale. Generally speaking, that's the month where you first advertise it for rent. If you move out of your property, for example, in March, and from March to June, you are preparing the property, you're making capital improvements, and you're preparing the property for rent. And then from, let's say, June 5th, you rent the property. Well, for depreciation purposes, June is the first month that you will be calculating your depreciation expenses and being able to submit those on your Schedule E to your 1040, for example, if that's how you do it. It's not going to be the case that you're able to take depreciation from when you moved out. You are taking depreciation from when you first rent the property. And generally speaking, the IRS has what's called a mid-month convention, which means that if you're renting the property on June 5th, they're going to treat depreciation as starting from June 15th, the middle of the month. Not a big deal, but something to keep in mind and to talk to a tax professional about. Another question people often ask is, I used to rent the property but now I've decided to move back into the property. Can I still take depreciation if it's not available for rent anymore? And the answer is no. Once you move back into that property as your residential unit, for whatever reason, you need to stop taking depreciation from the period that it ceased being rented to the public. It ceased being an income generating property. So if you rent the property for 6 months of the year and then you move back into it for the last 6 months of the year, you're only allowed to take that 6 months of depreciation. You're not allowed to claim any more and to keep going. You need to be aware of that. And again, talk with a tax professional about the exact dates that you're allowed to use and the exact implications of that. And also it might be good to talk to a tax professional about the general implications if you're thinking about moving back into a property, what that could mean to you, whether that means that you've abandoned your depreciation for some time, and then what happens if you decide to rent the property out again later. What does that mean in terms of how much remaining useful life do you have? Can you use it? This will all depend on what the current tax code says, and so it's important to coordinate any decisions that you make on rental real estate property in terms of switching from personal residence to rental real estate back to personal residence, possibly again renting it out later. You need to coordinate all that in advance to brainstorm with a tax professional who can advise you the implications of any course of action you try to make. So friends, that's a very short summary of how you can use depreciation to reduce your tax liability to the IRS from renting residential real estate. Generally speaking, it's the amount of money that you have as your cost basis in the property divided by 27 and a half years, depreciate that over 27 and a half years, and you can reduce that annualized amount against your rental income to reduce your taxes to the IRS. It's not something that is insignificant, so it's not something that you want to miss. So I hope that you found this helpful. And of course, there are other types of exemptions and deductions you can take for residential real estate in terms of your utility bills, etc., that you're paying on it. Those are all standard tax deductible in the year they're incurred. But here we're talking about depreciation. And if you're renting real estate, you want to take full advantage of the tax code and what it allows you to do. So I hope you found this helpful. If you have any questions, feel free to leave them in the comments below. I'll try to answer them as best I can. Take care. Have a great day.